Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. Over the last several videos I've been discussing the research I've been conducting and showing examples of how it plays out in the market, both in backtesting and forward testing. Those videos have been informative and quite valuable, but a lot of times meaning gets lost in just numbers. So in this video, I want to take some of the context of that research and demonstrate it in pictures, visual tools like charts that we can see how things correlate between a take profit and a stop loss. So let's get straight into the chart that we have on the screen. This chart is a representation of an algorithmic calculation based upon the research that shows an expected profit range. That is, from the market and from the information within the market, you can calculate reasonably well what potential profit exists within that market. So we're looking at just that with Euro USD on a 1-minute chart. The emphasis here is to look at liquidity, volume, and tradability of an asset. You can take this information and trade it directly, or you can take it and use it as an overlay to another strategy. But let's really get into the fine details of what this information represents. As we saw from the research, probability and statistics calculated the highest level of profits and profitability within a given time frame based upon either pips or percentages. For example, Euro USD, a 5 pip take profit with a 35 pip stop loss, had the highest profitability of that given time frame. Now, of course, because the markets change constantly, the forward test showed just how bad things can get, even with an auto close that actually worked very well. So what we need to look at is how can we predict market profitability versus exhaustion. For example, in the short that I put up this morning, talking about Euro USD bears losing momentum in the market, and then the bulls yesterday and today taking control again, setting up a very firm support level that looks like it's going to hold quite well throughout the rest of the session. That becomes realistic when you see what's going on in this chart. As we can see by zooming in to the most recent activity, we see that the blue lines or the boundaries are very narrow. They're not far apart. This tells you that the market doesn't have a lot of volume and liquidity in it at the moment. Now, that's an important consideration if you're trading. That's not to say it's not a good opportunity to get into the market, because it really is, if you're looking for a sideways market, because that is what this shows. Something to understand about what this is demonstrating is that when the bands are narrow, prices are consolidating or constricting. This is a shakedown that institutions use to get rid of smaller investors. And for the context of this discussion, an institution is a bank, a hedge fund, a large corporate entity investing in the market, or even just an individual that normally can't purchase retail-wise the way you and I do. That is, their orders are so large that their purchase would skew the market drastically if they were to place it in normal methods. So what they have to do is they have to wait for liquidity zones. And those liquidity zones only occur when they create them by shaking down retail investors through stop loss harvesting or other techniques to cause smaller investors to lose money. So we see a very narrow band or a shakedown zone. So if you're using a stop loss that is very tight or close to your price action, you're going to significantly feel the impact of this. If you're using an accumulation strategy like Jackrabbit TV, this is an opportunity to purchase at key points based upon whatever recipe you are using to accumulate with. But let's take a look at what happens when we see the market expand. Let's go back here. Okay, so here we have a reasonably narrow market. And then we have this huge expansion. This tells you that volume and liquidity within the market have increased significantly. That is, large institutions have made large purchases. Even though you don't see it that much in the price action, the mere fact that the candlestick pattern demonstrates over the course of the last 13 days that this pattern has taken on more significant liquidity. Larger players are coming into the game. And that is what you want to look for as a warning sign or potential opportunity. For example, if you're using accumulation, then this now becomes your point that you accumulate a new position. So where you had a narrow accumulation range, now because of market instability, your algorithm would pick this point as an accumulation range. So in essence, you're able to dynamically determine accumulation appropriate to your trading strategy, and or you're able to determine a safe area of a stop loss. So knowing where market liquidity is, knowing where market volatility is, and using this approach within your trading can help you accumulate or set your exit points on a safe and reliable level, comparatively speaking, to what the market is actually representing. Now, from the standpoint of your take profit, what's interesting here is you can see that this narrow band doesn't have a lot of profit in it, meaning that if you set your take profit too high, you are significantly going to be impacted in a way that you won't reach it. Whereas here, your take profit is elevated, which means you have the potential to make more profit. That doesn't mean the market is going to give it to you, because as we can see, even though the market shows potential for profit, the actual trending pattern is relatively sideways during this expansion. And as we continue, we can see even more so that it really doesn't offer that many opportunities for large profit positions, though it is still potentially possible that the market could become erratic and unstable during this period. And we continue with the wide range, and we see a very large green spike, or what basically is a huge input into the market. The institutions have made a major purchase. So let's zoom this section in. So you can clearly see where the market moves and how it impacted market data. So if you have a purchase, say here, at a relatively durable resistance zone, then you could have easily made a sell up here at a reasonable profit level. So by using these channels, by actually analyzing the market for when profitability is available versus when it is not available, you can see within a reasonable level of context that your profitability will be directly impacted on a dynamic level. And we can keep going, and we can see many opportunities here. And of course, that's the fallacy of backtesting. Backtesting always paints the rosy picture. Forward testing is where you see real market data when you can't see the unexpected. And here you can see the market exhausted itself. The market played its hand, it's done. Volatility and liquidity decreased. And now we are back to more of a sideways nature where the market simply isn't growing that well. One thing I want to point out though as I'm scrolling through this, don't be deceived by the auto scaling. This is not a large market. And in fact, you can turn off auto scaling. Let's go here. Let's turn off auto scaling. And now as I move, you can see the channel stays the same. Auto scaling is useful, but it can be deceptive if you're not aware of what's going on. This is not a very strong channel, as we can see over and over. But that doesn't mean that it's not profitable if you have the right technique. So let's continue, and you can see all the way up to the most recent market. It's very squeezed and not very many players. That is, the large institutions haven't gotten back in or out of the game yet. They're taking small positions in and out, but not major ones, which would bring the heavy and aggressive accumulation cycles or large volatility cycles. So looking at the bigger picture, you can clearly see just how the impact of the volatility and liquidity affects the market as a whole. And that really is the critical point of your trading. You want to be in the market when it is heavily volatile, when you have the liquidity to get out. You don't need a lot of pips or a high percentage to get in and out of the market with a profit, as long as you realize where the market opportunities are. That's really one of the critical points that the research has really brought into play. It has demonstrated where that research potential or profit potential is. So as you look at the market and you examine your opportunities, look at the places where liquidity is and is not in your market. Now this script is available to patrons and sponsors of Jackrabbit Relay. I have it in a supplemental repository already. So if you're on Patreon, make sure I have your GitHub user ID so you have access to this. It is open. You can take a look at it. You can manipulate it. You can see how it works. And we're going to talk about some of that now. For example, right here, this is a risk to reward of 1 to 1. So let's see what happens if we change it. Now, right now I have it set to the Forex market, which happens to be 13 trading days. It has a cryptocurrency setting, which happens to be 19 days. In both cases, both represent 65% of the number of trading days that you can do. The fact that these numbers are prime is no mistake. If you followed my channel and my trading information, You know I use prime numbers a lot. The coincidence of this coming back prime is quite interesting because it shows just how powerful the numerology of prime numbers is within trading. So let's take and actually examine. Based upon the research, we know a low stop or a low take profit versus a higher stop loss will give better results, providing you pick the right numbers and you've conducted enough research to find out what they are. So as you increase your risk to reward ratio, you begin to see exactly how that affects liquidity and volume within this approach. You begin to see from the standpoint of your trading some of the conditions that this opens up and gives you for information. And that really is the whole point of this information. You want to be able to make informed decisions. And those informed decisions require reliable information. Now let's switch to the cryptocurrency settings. And let's go to BTC USDT. As we've seen from the research, if the exchanges you are working with are fairly liquid, the exchange itself really doesn't matter. And here we are looking at Bitcoin USDT, and you see the volatility aggressively in the market. And now here you would definitely adjust your risk versus reward. But the ideal of this context, which is what I want to demonstrate, is a unique situation where you could actually use this script to trade on directly. So we see here at this point that this candle would break this point of view or the upper boundary. So this could be an entry point. And then you would follow it appropriately until price action broke the lower boundary, which would be over here. And you would take your profit. So by using this technique in a literal context, you can also get the perspective of being able to move with the market. That is, you have a dynamic stop loss and a dynamic take profit that can measure the market in real time as you trade and determine when and where to get in and get out. And in a market as volatile as cryptocurrencies, that is invaluable. So you really begin to see just how much your reference points really take place. And as we can see here, we have a tight squeeze zone. Here is a really tight zone, and here you can see a massive shakedown of liquidity. That is, larger players and institutions getting rid of the retails, hitting the stop losses. So this is where you really want to pay attention to this kind of information, because these kind of candles are telltale signs. For example, when you see something like this, wait for it to bottom out the way it did here, meaning you see the boundaries starting to move upwards. And then wait for an opportunity to make a reasonable profit. You have potential, you have ability, you have a process. Let the market tell you exactly when and where to get in and get out through mathematics. By using algorithmic trading in this way, not only do you get a structurized approach for trading, but you now become more informed about what the market can actually handle. One of the biggest misconceptions about algorithmic trading is that people think it automatically means you use a bot to do your buying and selling only. And that's not true. Algorithmic trading can also be using tools like this to find opportunities. And this is a clear opportunity that you can get into and exploit by understanding how liquidity works within the market, by understanding how the entire principle of liquidity, along with institutional players, can help you get an advantage point. You can see that this isn't very big, and you can increase the reward to risk ratio to a 2 to 2, which will give you a larger window. And that may also give you larger opportunities. So now we are still at a 1-to-1 ratio between the two of them, but now we can see within the cryptocurrency market, particularly with Bitcoin's volatility, that we have a slightly more different viewpoint. That is, we see a channel of probability. We know and we can calculate how often a candle will leave the zone. Just like Bollinger Bands, each level has a probability. If you use a Bollinger Bands deviation of 3, then 97% of the time, all price action will stay in those bands. By adjusting your risk and reward here, you get the same context. You can narrow down how often price leaves this range, and you, in essence, become able to predict where price is going to be. By predicting where price is going to be with a reasonable statistical approach, you can then look for situations where price leaves that expected area, and that opens an opportunity for an entry point or an exit point, depending upon what you are trying to accomplish. So, from the standpoint of the market, when you see it, you see the squeezes, you see where retail investors are being pushed out. You see the open entries where institutions or larger players are moving in or around it. For example, here larger players came in significantly at various levels for quite a while, in fact. But then as price moved, liquidity became less and less until finally liquidity was next to nothing. And either the larger players started selling off in small portions for profits, or they simply started shaking down retail investors through harvesting techniques to open up for another purchase. Now let's get one thing really clear on the market. You as an individual mean nothing to an institution. Your $10 or $20 is worthless. But when everybody is using a MACD, a Bollinger's Band, an RSI, or some other common technique, and you have 2 or 3 million of those people all using similar ideologies, harvesting becomes quite profitable. So this isn't about you. This is about the bigger game of you multiplied by several thousand. That is, several thousand people all using similar techniques, similar approaches, similar contexts for looking for opportunities. And this is why I use prime numbers. This is why I don't use similar techniques and strategies. This is why I prefer accumulation or graded trading. I try to make it difficult for the market to harvest my money by not following standardized processes. The risk, of course, is that in and of itself, the technique applies more risk to my trading. So I have to be on my game and realize what my risks are and be willing to pay for them when they happen. And they will happen. Here's a good example of an entry point and an exit point where volatility was very high and produced very good results. And you see here where volatility was really insane. A huge, huge level. But that huge level shows where accumulation or institutional transactions took place. It also shows you potentiality within the market. You see that potentiality. It's not a guarantee, but it does mean you have opportunity. It also means you have a way of dynamically mitigating your risks by understanding how this opportunity plays into your own personal trading techniques. So, download this script, play with it, look at it, plug it into TradingView, copy and paste it in, save it, and then add it to your charts. This is how you will get, overall, the basic consensus of what the market is capable of doing. The script itself is not very long. It's not very useful by itself either. But it is overall a simple process. It's a process I know that works because I use it in my grid trading. This is the technique I use in my grid trading to help me determine what my profitability can be. Not a guarantee, but by having a rough point that I can study. It's very simple to just go through and take care of it. As I said, this source code is available in the supplemental repository. You can download it and copy and paste it into TradingView. So make sure if you're not subscribed, subscribe either to Patreon or become a sponsor to the supplemental or to the Jackrabbit Relay, which will give you access to the supplemental script. Here it is. So through Relay, sponsor it, you get access to this and all of my research to date. And this is going to grow quite extensively over time. If you subscribe to Patreon, then you'll get articles and other items as well that come with that subscription. Let me know what you think. Leave a comment. If you found this video useful, please give it a thumbs up. Like it. Help other people learn how to really trade properly. Thank you for watching, and until next time.